Welcome back to Talk Tickers, the show where we don't just skim the headlines, we rip apart the transcripts so you don't have to.
Straight to the sword.
Exactly. We're bypassing the noise, going right to the data. And today we're looking at a ticker that, well, it's not getting the flashing lights on financial TV, but if you care about fundamentals, it really should be on your radar. We are breaking down the latest print from Old National Bancorp, ticker ONB.
That's right. And look, in a market that's just, completely obsessed with AI chips, it is so easy to overlook a regional bank.
It feels unsexy.
It feels very old economy. But Old National just dropped their Q4 2025 earnings. And while the market reaction was, let's just call it muted.
A shrug, basically.
A total shrug.
Yeah.
But the internal mechanics of this report, they just scream inflection point.
Exactly. So we're going to frame this deep dive around this idea of the quality compounder. This isn't some flashy momentum trade.
No.
This is a regional bank that has just wrapped up a massive integration with Bremer Bank and is posting efficiency numbers that, frankly, make the rest of the sector look a little bloated.
It's a lean machine. They're operating at peak efficiency while everyone else is still sweating over commercial real estate or, deposit flight.
Well, before we get into the gears of that machine, let's just hit the scoreboard. What was the headline print?
All right, let's do it.
Okay, so unpacking the numbers. For Q4 2025, Old National posted GAAP EPS of 55 cents. But we all know GAAP can get messy during mergers.
Oh, yeah.
The real number, the one the street actually trades on, is the adjusted EPS. That came in at 62 cents.
Which is a clear beat. And just for clarity, because I know people get skeptical when you start saying adjusted.
Right.
That adjustment excludes about 7 cents of what I would call legitimate noise. We're talking merger costs, pension stuff, some FDIC items.
Well, one-time things.
Exactly. These aren't recurring costs. So that's 62 cents. That's the real run rate earnings power here.
Right. But the number that really, it jumped off the page for me, and I know you feel the same way, was the efficiency ratio.
Oh, absolutely.
A record low adjusted efficiency ratio of 46.0%.
46%. We need to just pause on that for a second. Because if you aren't looking at bank balance sheets all day, you might miss how significant that is.
So what does that mean?
The efficiency ratio is just how much money the bank spends to make $1 of revenue. A lot of regional banks, they struggle to get that number below 55, even 50%.
So for every dollar coming in the door, ONB is only spending 46 cents to keep the lights on.
Precisely. Hitting 46%. That is elite territory. It just shows incredible operational discipline.
And that discipline flows right down to the bottom line, right? Their adjusted return on average tangible common equity, ROATCE, was almost 20%, 19.9.
That's a serious return. You're looking at top decile profitability. A 20% OATCE is the kind of number that usually gets a premium valuation.
Which brings us to the fascinating part. Despite these record numbers, the stock price reaction was nothing.
A total shrug. It was flat, down maybe 3 cents after the print.
Yeah, barely moved. But while the day traders were sitting on their hands, the analysts were busy upgrading.
The sell side woke up.
We saw Stephens raise their target to $28. TD Cowen upgraded to a buy with a $30 target, and RBC bumped theirs to $26.
And if you look at the tape, the volume was heavy. Over 4 million shares traded versus, a typical 2.3 million.
Right.
That tells me that while the price didn't move, hands were changing. The tourists might be selling, but the smart money's positioning because they see that disconnect.
So why the bullishness? What are the pros seeing? I think it all comes down to the big catalyst we mentioned, the Bremer Bank integration.
This is the critical piece of the puzzle. Management confirmed on the call, the systems conversion for Bremer is done. It's completed.
Correct.
But here's the real alpha, the hidden value.
Yeah.
In Q4, they only realized about 28% of the cost savings from that deal.
Wait, hold on. Let me make sure I heard that right. They hit a record 46% efficiency ratio, and they haven't even felt the full benefit of the cost cuts yet.
That is it. That's the whole thesis. Management explicitly said that 100% of those cost savings hit, starting in Q1 2026.
So right now.
Right now. So you have a bank that's already hyper-efficient, walking into the new year with a massive expense tailwind just waiting to happen.
That's a massive setup for operating leverage. Every new dollar of revenue just drops straight to the bottom line.
It is. But okay, let's play devil's advocate. The reason regional banks have been so beaten up is fear, right?
Fear credit, fear of recession.
Fear of commercial real estate. How does ONB look under the hood there?
That's the sleep well at night factor. If you're worried about a CRE collapse, this report seems to completely contradict that narrative.
It really does. Their credit quality is actually improving. Look at the data points. Criticized and classified loans, the ones the bank has flagged as maybe being a problem.
The watch list.
The watch list. It was down 8%. That's a $278 million decrease.
Yeah.
Non-accrual loans, where people have actually stopped paying down 12%.
That's a big move in this environment. So what about the big one, commercial real estate?
Management gave a very specific stat that I loved. In their CRE portfolio, upgrades and payoffs exceeded downgrades by a 2-to-1 ratio.
2-to-1 positive. That is definitely not what you hear on the nightly news.
No, it isn't. And as for actual losses, net charge-offs, NCOs, were 27 basis points, which is already pretty low.
Okay.
But there's a nuance here with something called PCD loans.
Okay, break that down, PCD.
It stands for Purchase Credit Deteriorated. So when ONB bought Bremer, they acquired some loans they already knew were stressed. They got them at a discount.
Right. It's like buying a used car and you know there's a dent in the bumper. You paid less for it because of the dent.
Perfect analogy. So when those loans eventually charge off, it's not a surprise. It was already priced in. If you strip out those PCD loans, the known dents, the net charge-offs were only 16 basis points.
16 basis points. That's basically nothing. It's pristine. Okay, so the credit cliff isn't happening here. Let's shift to the income engine. Net interest income, NII.
Came in at $588.8 million.
And what's the outlook for margins?
Stable to improving through 2026. And this is where it gets really interesting. It's all about the repricing ladder.
Okay, explain how that works for ONB right now.
Sure. Think of their assets, their loans and securities, as a ladder. Rungs on a ladder. Each rung is an asset with a rate and a maturity date. As time goes on, the low rate rungs from a few years ago mature.
And they take that cash.
And they reinvest it at today's much higher rates.
Yes.
Management said new money yields on securities are 94 basis points higher than what's currently on the books.
Wow, almost a full percent.
Right. And they have $2.9 billion in securities cash flow coming over the next 12 months. That's a natural mathematical updraft for their margin. They just have to wait.
But that's only one side of it. What about what they're paying for deposits? Aren't those costs still going up?
They were, but that tide is turning. The cost of deposits actually dropped 17 basis points last quarter.
That seems really fast. How?
They talked about their beta management. Deposit beta is just how much of the Fed's rate move gets passed on to you, the customer.
Right.
On their exception price deposits, so their big, expensive clients, they achieved an 87% beta when the Fed cut.
So when the Fed cut rates, ONB immediately slashed what they were paying those expensive depositors by almost the same amount.
They are clawing back margin aggressively. And the key is they aren't losing customers over it. Their loan-to-deposit ratio is at a comfortable 89%. The franchise is solid.
Okay, so the engine is running clean. Let's look forward. What's the guidance for 2026 telling us?
They're projecting loan growth of 4 to 6% for the full year. Healthy, sustainable growth.
And what are they assuming about the economy? Are they, betting the farm on some perfect scenario?
No, and this is what I liked. The assumptions are very pragmatic. 2 Fed cuts this year, 25 basis points each, and a 5-year Treasury around 3.75%.
That feels very middle of the road.
It is. And they used a phrase that I think is critical for investors. Neutrally positioned.
Okay, unpack that. Neutrally positioned to short rates.
A lot of banks make huge bets. They set up their balance sheet to make a killing if rates go up or if rates go down. But if they get that macro call wrong...
Like Silicon Valley Bank did.
Exactly. They get crushed. ONB is basically saying, we don't care. They're hedged. If rates stay high, their assets reprice higher. If rates fall, their deposit costs plummet because of that high beta. They've taken the macro risk off the table.
Which lets you focus on the business execution.
Right.
And speaking of focusing on shareholders, let's talk capital allocation. This is where the story gets really juicy. They bought back 1.1 million shares in Q4.
And that's 2.2 million for the full year. But the real signal came from the CFO. He explicitly said they plan to be more active with buybacks in 2026.
More active. That is CFO speak for, we think our stock is dirt cheap.
Absolutely. And they have the capital. Tangible book value per share grew 15% last year. And remember, that is after absorbing $140 million in merger charges.
15% growth while digesting a major acquisition is impressive.
This bank generates so much capital, they almost have to buy back stock or they'll become overcapitalized.
So when a bank has all this extra capital, investors get nervous, they'll go do a dumb M&A deal. What's the CEO saying about that?
He's cooling the jets on big deals. He talked about investing in ourselves, talent, tech, that kind of thing.
I noticed they mentioned a hiring push in wealth management.
Exactly. It's organic growth now. They've got the footprint they want. Now it's about going deeper with clients. It's a much lower risk strategy.
Plus, it sounds like the CEO is in a pretty good mood. Did you catch the opening of the call?
I did. It's not something you usually hear. He started the formal earnings call by congratulating the Indiana Hoosiers on their perfect season and winning the national championship.
I loved that. It just gives you a sense of the culture. This isn't some Manhattan boardroom. It's Evansville, Indiana.
It matters. It speaks to confidence. A CEO under siege is not cracking jokes about college football. It projects a real level of comfort.
Okay, so let's summarize. Beat on earnings, record efficiency, a massive cost-save tailwind kicking in right now, clean credit, and a management team buying back stock and watching football.
And despite all of that, the stock traded flat.
Right. The sell side sees a path to $30, but the market is asleep. That disconnect is where the opportunity lives.
It's the classic efficiency lag. The market hasn't priced in the Bremer savings because they haven't hit the bottom line yet.
Yeah.
But we know they're coming. It's just math.
And that, my friend, brings us to our favorite part of the show.
The disclaimer section.
The disclaimer. Listen closely. Nothing we say here is financial advice. We are just voices in your headphones reading transcript. Do your own work.
Please.
But if we were pitching a trade based on this deep dive, what would it be?
All right, let's pitch it. I'm calling this trade the Hoosier Efficiency Arbitrage.
I like it. What's the setup?
The setup is simple. The market is pricing ONB like just another regional bank. It's ignoring the specific catalyst of the Bremer cost saves that are about to hit.
So you're saying the machine is about to get even leaner and the market hasn't done the math yet?
Exactly. My thesis is that in Q1 or Q2 of 2026, ONB prints an efficiency ratio below 45%. That makes them one of the most profitable regionals in the entire country. And the market will be forced to re-rate the stock higher.
Okay, so what's the trade structure?
You go long ONB, but to hedge out the sector risk, you go short a basket of what I call high CRE, low efficiency coastal banks.
The sloppy regionals.
The sloppy ones. You know who they are. Efficiency ratios in the 60s, a ton of office exposure. By shorting them, you remove the macro risk. You're just betting on ONB to outperform the pack.
You're betting on execution. And you've got that more active buyback putting a floor under the price.
Precisely. It's an arbitrage on operational excellence.
And what's the outrageous kicker? There's always a kicker.
The kicker is that they generate so much capital, they run out of things to do with it. So the CEO uses the excess cash to buy the film rights to Hoosiers 2.
And casts himself as the coach.
And casts himself as the coach, just to keep the winning streak alive.
Honestly, if they keep printing 20% ROATCE, the shareholders might let him do it.
Winning cures all.
It sure does. Okay, let's wrap this up. Recap for everyone.
4 things. 1, ONB delivered a beat. Journals and 62 cents adjusted. 2, credit is cleaning up, not getting worse. 3, the Bremer integration is done, setting up a huge cost-save tailwind for this year.
And 4, buybacks are ramping up aggressively because management thinks the stock is too cheap.
The sell side sees a path to $30. The market left the stock flat at 24. That gap is the opportunity.
Couldn't have said it better. This has been Talk Tickers. We read the transcripts so you don't have to.
We'll catch you on the next print.